Okay. Hi everyone, and thank you for joining, and welcome to the Heffron and Class joint webinar on compliance and tips and traps for June 30. My name is Dina McCaleb, and I'm the Client Relationship Manager here at Class. It is my pleasure to introduce our speakers for today. First off, we have Kevin Zhang, the Technical Compliance Manager at Class. Kevin has been the Compliance Manager at this Class for over 14 years. He is a manager of the SMSF Administration Tax and Accounting software and development experience, and has been an integral part of the Class team for over 14 years here. Kevin's role involves examining and interpreting regulatory changes for developing and implementing into Class. Second, we have Lyn Formica. Lyn is the Head of Education and Content at Heffron, where her passion is to help clients and their advisors navigate their way through Australia's retirement system through education. With over 30 years of experience in superannuation and administration of self-managed funds, Lyn is also an accredited SMSF Specialist Advisor of the SMSF Association. That is our speakers for today. We also further have Annie Dawson, an SMSF Specialist from Heffron, Calvin Siu, who is a Technical Compliance Analyst at Class, and Chris Lai, the Support Analyst at Class, to help assist with any questions you may raise during the webinar. Thank you very much, everyone, and over to you, Lyn.
Wonderful. Thank you for that lovely introduction, Dino. So our topic today is, as we said, some tips and traps to get you through the 30 June period. So we're going to be talking around contributions, indexation of the transfer balance cap and how that's going to impact contributions going forward, some updates, some tips in relation to pensions, talking through the implications of the new T-bar reporting deadlines, and then also the issues to be checking for pre-30 June when you've got clients which are dealing with related parties. As we said, Annie Dawson is on the line to answer any of the questions in relation to my content today. So good luck, Annie. So our first topic to talk through is contributions. And the typical problem that we have with clients in the lead up to 30th of June is that they leave it too late to make their contributions, because, as you know, for a contribution to count towards a particular year's contribution caps or be claimed as a tax deduction in a particular year, that contribution needs to be made in that year. And generally speaking, made means it needs to have been received by the superannuation fund. So clients who are making last minute contributions can find that they don't get their contribution in before that 30 June cutoff date. And often the typical problem that we have is when clients are using clearinghouses. So lots of our clients do use a clearinghouse these days to make their superannuation contributions, particularly with the introduction of super streams. So what I'm talking about, a clearinghouse is where the employer is making a deposit with the clearinghouse. The clearinghouse is then responsible for distributing that contribution amongst the various different superannuation funds, and then the fund will be eventually credited with that money. And it can take some time to get from the employer popping the contribution into the clearinghouse to the money actually hitting the superannuation fund's account. And unfortunately, generally speaking, your contribution isn't considered to have been made until the fund is credited with the money. So if we leave it too late, as I said, you can find that the fund doesn't get credited with the money until, say, the 1st of July, which would mean that it would count, it was being made in the following financial year. Having said that, if your client is using the ATO, Small Business Clearinghouse, then we have special rules. So if we use the ATO, Small Business Clearinghouse, then your client's SG obligations are satisfied when they've paid the money to the clearinghouse. On the basis of PCG 2020/6, we can also, the employer is also allowed to claim a tax deduction for that superannuation contribution when they pay the money to the clearinghouse. So that gives us a lot of flexibility from that perspective, but it's only for those clients who use the ATO Small Business Super Clearinghouse. If they're using any other clearinghouse, then for tax deductibility purposes, contribution hasn't been made until the fund is credited with the money. And regardless of which clearinghouse you're using, for contribution cap purposes, again, it won't count for your cap until the contribution's been made, so potentially that following financial year. So definitely something just to be mindful of. The ATO Small Business Clearinghouse will always give you the cutoff dates on when a contribution needs to be popped into the clearinghouse to get it in time for our 30 June cutoff. The other thing I wanted to remind people about is some of the changes that were introduced with effect from the 1st of July 2022. So as you may be aware or recall, significant changes to the contribution eligibility rules with effect from the 1st of July 2022. And it means that trustees can accept contributions for members aged 67 to 74 without them needing to meet a work test. So historically, you're processing 21, 22 year ends. If you've got clients between 67 and 74, you're getting a work test declaration from them because that was a condition of eligibility to make that contribution or have the trustee accept that contribution. Those rules went out the window on the effective the 1st of July 2022. Trustees can accept a contribution for members between 67 and 74 without them having to meet a work test. So auditors are going to be no longer asking for a work test declaration in respect of 22, 23 year ends. Work test only comes into play where your client has made a personal superannuation contribution and they want to claim a tax deduction for it. For those members in that age bracket of 67 to 74, they're only entitled to claim a tax deduction for the contribution if they've met the work test at some stage in that particular financial year. Otherwise, their tax deduction gets denied. So we've effectively moved the work test scrutiny from the auditor of the superannuation fund to the tax agent of the particular member, because it's the tax agent of the member who needs to be comfortable that this person has in fact met the work test before they claim a tax deduction for that particular superannuation contribution. The other change I wanted to remind you of, well, actually it's not a change, it's just something to be aware of, is once your members get to 75. So once they turn 75, trustees can't accept contributions from their employer unless they're SG or they're mandated contributions. And that's regardless of whether they meet the work test or not. So this isn't a 1 July 2022 change. This has been around for years. It essentially means that age 75 is your cutoff date for employers putting in voluntary superannuation contributions, such as salary sacrifice contributions. I say 75, technically speaking, it's the 28th day of the month after the person's 75th birthday. So if they were turning 75 today, they'd have until the 28th of May to have their final voluntary employer type of contribution going in. Once we get past that date, it's only SG or mandated superannuation contributions that can be accepted. So no point getting them to sign a work test declaration. That doesn't help. Satisfying the work test is not one of the criteria. It's the type of contribution that is the critical factor. So it needs to be an SG or a mandated and an award type of contribution to be accepted after that age bracket. The other thing to bear in mind in relation to superannuation contributions is the 1 July 2023 indexation of the transfer balance cap. So we know that the general transfer balance cap will index to $1.9 million effective the 1st of July 2023. Unfortunately, our contribution caps are going to stay the same at $27,500 for a concessional contribution and $110,000 for a non-concessional contribution for the 23-24 financial year. That's just simply because we use different indexation factors for both of those caps. So transfer balance cap gets indexed with CPI, which was enough to give us a jump of $200,000, whereas our contribution caps are indexed with awardee wage increases, which weren't quite enough to get us any increase there. So we'll talk about the indexation of the transfer balance cap in a moment, but not everyone gets any of the benefit of that transfer balance cap increase. But the fact that the general transfer balance cap is increasing can benefit lots of people because it has an impact on their contribution thresholds for bring forward rules for non-concessional contributions. So you'd be familiar with the table on the right there, our thresholds for bring forward rules for making non-concessional contributions in the current financial year. So if your client's total superannuation balance was less than 1.48 at 30 June 2022, then they have a $330,000 non-concessional contribution cap. Whereas if their balance was 1.7 or more at 30 June 2022, then unfortunately their non-concessional contribution cap is zero. Now, those figures in that threshold come from the fact that the general transfer balance cap at the moment is $1.7 million. But with that increasing from 1.7 to 1.9, we get a new table of thresholds for next financial year. So you'll see that from next financial year, we've got a $200,000 increase in those various thresholds amounts. So if my total superannuation balance was less than 1.68 million at 30 June 2023, then and I've got a $330,000 non-concessional contribution cap. And it's only once I kick over the 1.9 million total superannuation balance do we end up with a zero cap. So that has the potential to lead to some opportunities for your client for next financial year. So you might have someone like Elaine. She's retired, she's 68. Her personal transfer balance cap is 1.6. She used that in full back in 30 June 2017. She's not in bring forward mode. She hasn't made non-concessional contributions for many years. Her total superannuation balance at 30 June 2022 was 1.76 million. So unfortunately, over the $1.7 million threshold for this current financial year. Now, there's no work test anymore for non-concessional contributions, but Elaine's problem is her super balance is too high. She would be eligible to make a non-concessional contribution, but her cap is zero because her super balance was more than 1.7 at 30 June 2022. So it looked like the removal of the work test came a bit too late for Elaine, because by the time the work test was removed, effective the 1st of July 2022, her super balance had grown so much that her cap is now zero. But we need to rethink people like Elaine for next financial year because of the increasing of those thresholds. So if, for example, Elaine's total superannuation balance, if we project it forward, and we think it's going to be about 1.86 million at 30 June 2023, that's less than the 1.9, the new threshold for non-concessional contributions. So she would have a non-concessional contribution cap of 110 next financial year. And in fact, so long as we could get her total superannuation balance less than 1.68 million at 30 June 2023, her non-concessional contribution cap would be 330. So Elaine's advisor might even be looking at and thinking, well, I could perhaps take a withdrawal. Elaine could take a withdrawal before 30 June to get herself under the 1.68 million and then be able to put more money back into superannuation for next financial year. So Elaine is the type of client that accountants and advisors will be looking at. Even though they might not be able to get a non-concessional contribution in this year, they may certainly be able to do one next year. So there's opportunities for Elaine next year to get more money into super if that's what she wants to do, or perhaps even do a withdrawal and recontribution strategy. The fact that Elaine has fully utilised her own personal transfer balance cap and she doesn't get the benefit of the transfer balance cap indexing to 1.9 doesn't change the situation, because these thresholds for contribution purposes are all based on the general transfer balance cap, not anyone's personal transfer balance cap. The other thing that we have to watch out with for contributions is notice requirements. So some types of contributions have special rules. So a downsizer contribution, for example, if I want a contribution to count towards my downsizer contribution cap instead of my non-concessional contribution cap, then I have to give a form to the trustee, a downsizer contribution form. But I've got time frames for that. I have to give that to the trustee of the fund on or before the day the contribution is made. If I don't get it in on time, then it simply can't count towards my downsizer cap. So it means it would count towards my non-concessional contribution cap if I was eligible to put contributions in. If I'm too old, I'm over age 75, for example, downsizer is the only opportunity I had. I didn't qualify for downsizer because I didn't get the form in on time. Then in fact, I've got an ineligible contribution which would need to be returned to me. Same thing with a CGT cap contribution. If I want it to count towards my CGT cap instead of my instead of my non-concessional contribution cap, again, I have to give the CGT election form to my fund on or before the day that contribution is made. And there's no windows, there's no extensions. Those forms just have to be given to the trustee on or before that day that contribution is made. So definitely something to be checking for when you've got clients wanting to make those sorts of types of contributions. The other type of contribution that has notice requirements is when your clients are making personal superannuation contributions and they want to claim a tax deduction for that contribution. So they need to give a section 29170 notice to the trustee of their fund within particular timeframes. So let's say the contribution was made in 21-22. They want to claim a tax deduction for it in 21-22. So they need to give a notice to the trustee of their fund before the end of the day on which they lodge their tax return, their personal tax return for 21-22. or 30 June of the following year. So if they haven't lodged their personal tax return by 30 June 2023, their cutoff date is 30 June 2023. They can't give the notice after that particular date. And there's no discretion here. There's no provision for the ATO to allow an extended time period. It's not one of those sections that says, well, such longer period as the commissioner allows. So again, if you don't get the notice in on time, you're just not entitled to a tax deduction for that superannuation contribution. We also have to be careful because there can be particular events that can make our notice invalid. So if we give our notice after these events have happened, then we're not entitled to claim a tax deduction for the contribution. So this will be where we've already started a pension with the account balance in which that contribution was made. So I've popped my contribution in, it went into an accumulation account, and then I started a pension from all or part of the money sitting in that accumulation account. If I've done that, and I haven't yet given my notice to my fund, so sad, too bad, I will not be entitled to claim a tax deduction for that superannuation contribution. My notice can also be invalid if I'm no longer a member of the fund. So because perhaps I've rolled all of my benefits over to somewhere else, or I've withdrawn all of it in a lump sum. If I've only part of my contribution has been withdrawn as a lump sum or a rollover, then a partial deduction may be available. But it's usually easier to make sure that we get our notices in before any of those events happen, and then we don't have to worry about a scale back of our tax deduction. Also need to be mindful I have to give my notice before I lodge an application to split my contribution with my spouse. And that's simply because when I first put the contribution in, it'll look like a non-concessional contribution, and you can't split non-concessional contributions with your spouse. The moment I give the notice to the fund to say I want to claim a tax deduction for it, it'll turn it into a concessional contribution, and that's the type of contribution that I can split 85% of it off to my spouse. So I need to make sure I give my Section 290 170 notice first, and then I can elect to split it with my spouse. So I would just want to check with you guys that we're all understanding, excuse me, those notice requirements with a couple of examples. So I've got Rose. She made a personal contribution to super in 21-22, and she wanted to claim a tax deduction for it. She lodged her tax return for 21-22 on the 15th of October 2022. On the 1st of July 2022, she commenced a pension from the same super interest that she put that contribution into. So by when should Rose have given a notice to her fund and received an acknowledgement from the trustee that she planned to claim a tax deduction for that contribution? So our options are 30 June, 1 July or 15 October. Kevin, if you could launch the poll so people can pick their answers, that would be great. Presume there's a few answers coming in. Feel free to close it whenever you like there. Kevin, if you can see that answers dwindling off.
Yeah, it's hitting over 50%.
Yeah, excellent. So the correct answer there is actually the 30th of June, which is fantastic. I'm really great that most people have gotten that answer. 1 July can actually also work because if we do 1 July, we just have to play with our pension documentation. So if I want to give my notice on the 1st of July and go to pension phase on the 1st of July, ideally I play around with my pension documentation. So I indicate that I want to go to pension phase after the trustees acknowledge receipt of my Section 290 170 notice. If I don't want to have to play around with the pension documentation, then just get your notice in on the 30th of June, and then your pension documentation can just be normal standard pension documentation. So my next question is Min. So Min's in pension phase and she's also making contribution to superannuation. Her transactions for 21-22, she had a pension payment on the 14th of April. She popped a contribution in on the 28th of May that she wants to claim a tax deduction for. And she took a lump sum from her accumulation account on the 15th of June. She's one of those people who put in some standing instructions at the start of the year that essentially said, Any payments I take are initially a pension payment until I've reached my minimum. And then once I've paid my minimum, it'll be a lump sum from my accumulation account, please. So that payment in April was a pension payment, and then that satisfied her minimum. And then the one on the 15th of June automatically became a lump sum from her accumulation account because of those standing instructions that she gave to the trustee at the start of the year. And she lodged her tax return on the 15th of October. So what date should Min have given her notice to her fund and gotten an acknowledgement for her to be able to claim a full tax deduction for her superannuation contribution? So we've got 28 May, 14 June, or 5th of October. If Kevin, you could launch the poll. How's the questions going, or the responses going, I should say?
It's hitting 55%, 56%. So I'll end the poll now.
Yeah, thank you.
And share the results.
Wonderful. So we've got a little bit of a mixed bag there, but certainly 14th of June is the correct answer. So we need to make sure that we've given our notice to the fund before we take the lump sum from that. So contribution went on the 20th of May. So we need to make sure we've given the notice before that lump sum on the 15th of June. Some people also picked the 28th of May, and you know what? That's a great day to give the notice. Give the notice the day you pop the contribution in. If I know I want to claim a tax deduction for it right then and there, and that's going to make things a lot easier. But do it on the 5th of October, and unfortunately, it'll be so sad, too bad, that wouldn't be entitled to a tax deduction for that. So just something to be mindful of, just thinking about those notice requirements, because you don't want to have a client thinking they're eligible to claim a tax deduction for it when they're not. And I do expect that we'll have a little bit more attention in relation to Section 291.70 notices, particularly around those clients between 67 and 74 for the 22-23 financial year, just with the ATO having responsibility for that rather than it being an audit requirement. So just moving on now to the topic of pensions. Of course, we need to make sure our minimum pension is paid before the 30th of June. The number one tip, what do we have to do to make sure that we're clients in the best position? Make sure that minimum is paid before the 30th of June. So being careful with electronic funds transfers. If your client's gotten to the 30th of June and realize they haven't made the payment yet, a check is their best friend, old school like me. If you've still got a checkbook for the superannuation fund, write a check to the member, give it to the member, and you've made that pension payment. It doesn't matter that the member doesn't bank it that day. They just need to bank it within normal commercial terms, so your next day or so. But when we make EFTs right at the last minute, the money's not going to leave the fund before the 30th of June. Also be mindful of drawdown rates when you're doing your reviews of fund in the lead up to 30th of June, making sure they've paid the minimum pension. They might also be telling you that, actually, we plan to take quite a large payment before the 30th of June because perhaps they're going on a holiday or, wanting to buy a caravan, those sorts of bits and pieces. And it's important to remind clients, I think, that the drawdown rates have been halved for quite some time. Are they going to return to normal in 23-24? Well, certainly, based on the wording of the current legislation, the halving of those rates will cease on the 30th of June 2023. So the government would have to put in amending legislation to continue them for another financial year. I don't expect they will continue. I didn't expect them to continue last year, so I can obviously get it wrong. But it's just something to be mindful of, to warn clients that, that $50,000 that you took this year as your minimum, that's likely to be at least $100,000 next year because of the halving of the rates. Just so they're not taking a big payment before 30 June that they thought, well, actually, I could have taken that in July. It still met my holiday requirements and not having to take extra money out of my fund. Pension payments also need to be paid in cash. So if your client's doing an in-specie payment, so an in-specie transfer of an asset from the fund, that can only be a lump sum from their accumulation account or a partial commutation from their pension account. If we want something to be treated as a pension payment, then it needs to be a cash payment. And just while we're talking about partial commutations, I just want to remind people of the differences between a partial commutation and a full commutation, particularly around the minimum pension calculation. So a partial commutation is when a balance remains in that pension account after the lump sum commutation happens. So I've got $1 million inside my superannuation fund, and I say to my trustee, I would like to take a lump sum commutation of $50,000, please. Obviously, I've still got $950 remaining. It's a partial commutation. So the advantage of partial commutations is the fact that my pension doesn't cease. So I've still got $950,000 in that pension account. My pension doesn't cease. My claim for exempt current pension income doesn't cease. The downside is the fact that because the pension doesn't cease, my full year's minimum still needs to be paid in that particular financial year. So whatever was calculated by the trustee or the accountant on the 1st of July, let's say it was based on a balance of $1 million, that's still the full minimum that has to be paid, even though I've taken out a lump sum commutation. And if that was a really big lump sum commutation, that might feel strange, because you might think, well, maybe my commutation was actually $900,000 and I only left 100 grand behind. That $900,000 is still a lump sum. It doesn't count towards my pension. I've still got the same minimum that I have to still draw. If there's not going to be enough money left in the account to pay my minimum, my full minimum for the year, before the commutation, then I need to have taken up a pro rata of the minimum. But I still have that obligation to take the full year's worth of minimum. And that's something that often people forget about, or they don't leave enough money behind. We saw a fund recently, they had taken a lump sum commutation, felt there was enough money left behind, asset values dropped, and they didn't still have enough money to pay that full year's minimum, which meant they lost their minimum pension exemption. So the ECPI exemption was gone because they had failed to pay the minimum pension for the year. Whereas full commutations work differently. There's nothing left in the pension account. My pension has ceased. In that particular situation, I'm only taking a pro rata of my minimum prior to that pension ceasing. So in that situation, I'm not having to take the full year's worth of minimum. I'm just taking a pro rata based on the amount of time that's left, the amount of time that's existed there. Well, moving on then to indexation of the transfer balance cap. So as I've been talking about the fact that the cap is increasing to 1.9, not everyone's going to get the benefit of that. Only clients who haven't ever had an entry into their transfer balance account before the 1st of July 2023 will get the full 1.9. So people who've never started a retirement phase pension yet. You'll have some clients who've used up the full 1.6, some clients have used up the full 1.7. They're not then entitled to any further indexation. And essentially what amount they're entitled to is based on the lowest ever cap space that is left. So you may have used in the past Heffron's transfer balance cap calculator. We're in the process of updating that for the 1 July changes as well, so that you'll be able to run it through and do a quick calculation for those clients where you're trying to do some planning as in terms of how much pension they could start on the 1st of July, for example, or how much pension could they commute, because we know that their spouse has passed away in 12 months' time, the reversionary balance is going to count across those sorts of things. Whilst we're talking about transfer balance accounts, those sorts of things, the lodgement dates for transfer balance accounts is changing. So at the moment, you'll have clients that are either annual reporters or quarterly reporters. And whether they're annual or quarterly was based on their total superannuation balance of the members. At the 30 June before, the fund had their first T-bar event, essentially. Annual reporters obviously a lot easier because the T-bar for their particular events doesn't need to be lodged until the SMSF annual return for that particular year is being lodged, whereas quarterly reporters need to lodge by the 28th day of the end of the quarter in which that particular event has happened. Come the 1st of July, there'll be no concept of an annual reporter for T-bar purposes. All of our funds will be quarterly reporters. So all funds will be required to lodge T-bar if they have an event by the 28th day of the end of the quarter. And under transitional rules, all events in 22-23, they'll need to be reported to the ATO by the 28th of October 2023. Now remember, this is only if we have an event. So if we've got, say, a pension commencement, a pension commutation, a pension reverting to somebody else. We don't need to lodge a T-bar for lump sums from accumulation accounts or pension payments, for example. And the moment I tell people about these changes to the reporting dates, the next question I usually get is, "Ooh, so what are the penalties if I lodge late?" So the penalties, technically speaking, are the same as late lodgement of any ATO approved form. So $275 at the moment for each 28 days that it's late, up to a maximum of 5 times that. Having said that, the ATO are still in educative and supportive mode in relation to T-bars. So I'm not aware of anyone being penalised for late lodgement of a T-bar, but it still needs to be something that you need to be mindful of and have your business working towards being able to meet these lodgement dates. A question that's often raised, or someone says, well, we can't possibly comply with those dates, because what if I've got someone who's starting a pension on the 1st of July? I don't know what their pension starting balance is, and I probably won't know that until after the 28th of October. Now, for T-bar purposes, we are permitted to use a reasonable estimate of the account balance, but it's only for T-bar purposes. For the purposes of the fund's financial statements, ECPI calculations, we have to use actual value of that pension. So what are our options? We could lodge a T-bar with an estimate of what we think the pension starting value is, and then cancel and re-report once we do know the actual balance. Not a fan of that option. I don't like re-reporting for T-bar purposes. I always think I'm going to make a mess and make the problem even worse. I could lodge late. It's an option, I suppose, until the ATO start penalising. I probably also need to be thinking about whether I could use crediting rates. So your fund's trustee would normally talk about the fact that when we're making a benefit payment, such as starting a pension or even taking a lump sum, the trustee is allowed to use calculate the earnings rate, the earnings to be allocated in a fair and reasonable manner. Well, a fair and reasonable manner would be to declare a crediting rate for the particular period or financial year, and then use that as calculating the actual members balance. So I need to have some justification for the rate that I've calculated, but I could then use that as the actual starting balance for this pension, for T-bars, for my pension documentation, my actual financial statements, and my ECPR calculations. That will be the starting balance of that pension, and it will not change regardless of when I actually fully process that fund in the financials. I'm going to lock down the figure and it won't change. So that's an option that I think we're not necessarily exploring often enough, and not just with pensions, but for any lump sum withdrawal that we're having to take as well. All right, we're just moving on to my last topic before I hand over to Kevin, and that's in relation to dealing with related parties. And there is anything that we need to be mindful in the period leading up to 30 June. So one of the most common things that we have self-managed super funds when they're dealing with related parties is because they're leasing an asset to a related party. Any asset that a self-managed super fund leases to a related party is generally in-house asset, subject to the 5% in-house asset limit, unless it's business real property. It also has to be subject to a legally enforceable lease arrangement. I also need to make sure that I'm maintaining that lease arrangement on an arm's length basis. So I need to make sure I agree to the terms and conduct the arrangement on commercial terms. So I'm thinking about, well, what's the market value of the rent? What's the appropriate term of this particular lease? How frequently will the rent be paid? Who's responsible for outgoings? When is the rent going to be reviewed? Those sorts of things. So typically speaking, before I put the lease arrangement in place, I'm going off to my leasing agent, independent party with experience, to tell me what is the market rate of rent and what's the normal term. Is it a 3-year term, a 5-year term? Do I index to CPI each 1st of July and then rent review after 3 years? All of those sorts of bits and pieces would be negotiated or the information given to you by the leasing agent, so then you can put that into a legally enforceable lease arrangement and then follow it. But we often these days are getting questions like this one, where we've got Bilbo, his self-managed superannuation fund owns business real property, which it leases to a related party. The lease agreement was entered into 18 months ago on market terms. So they went to a leasing agent, they determined what the terms were. It was a 3-year term with $88,000 worth of rent to be paid. But the self-managed super fund trustee went off to to get an opinion, a valuation of the property for the purposes of the fund's financial statements. So we could make sure that it was valued at market value in the fund's financial statements. As part of that, the agent also indicated what the current market rate of rent was, and it's 102. So the question we often get is, well, should the super fund be increasing the rent from 88 to 102 in line with that new recent valuation? I've even seen auditors suggest, hey, trustees, you need to be looking at this. Well, actually, no, they don't. They entered into a lease agreement. It's a 3-year lease. They don't get to change the rent for 3 years, other than in accordance with the CPI increase or whatever rent review was provided for in that particular lease agreement. Now, that's the benefit of having a lease agreement in place. So long as it was market at the time, then that rental arrangement stays the same as per that lease arrangement until the end of that 3-year term. Then we can review to market again. The other issue that we're often getting is prepayments of rent. So this is where the tenant might ask, can they prepay some rent, or the landlord, the super fund, may ask for a prepayment. Now, usually 12 months prepayment, up to 12 months, is usually okay. We would still want the landlord and the tenant to have a resolution acknowledging the terms, how far in advance they have prepaid, what was the circumstances, why did we have a prepayment? It may simply be that the tenant wanted a tax deduction. Once we go past 12 months, though, it changes. We would normally expect more favourable terms. So perhaps a discount on the rent, maybe an extension of my term. But I'd need some sort of evidence to justify the commerciality of that transaction and to document the arrangement. And that all needs to be put in place. Because the problem is, if the arrangement isn't commercial, and the super fund has received too much rent, because I've received rent not in accordance with the lease agreement, and it's higher than you would expect, it's a prepayment that I've got no justification for, then all of that rent is gnarly and it's taxed at the 45% instead of the 15% rate. The other thing to be mindful of is self-managed super funds are cash receipts taxpayers. So prepayments of rent are taxed in the year of receipt. We don't get to just put it through into a creditor account or something like that and not tax it until the year that it relates to. I pay $100,000 worth of rent. I don't care what year it relates to. The $100,000 rent is taxed in my self-managed super fund in the year I received it. The other issue to be watching for before the 30th of June is our trust distribution. So this is where we've got self-managed superannuation funds investing in related trusts. So let's say my first example is a related 1322C trust, a non-geared trust, sometimes we call that. So in this particular fund, the self-managed super fund owns units in the trust, and the 21-22 year distribution has still not been paid. So we did the accountant did the financials for the trust in October 2022, declared the distribution, and we're now sitting here at end of April 2023, and that distribution has still not been paid. What are the implications of that? Well, essentially, that these parties are related parties. And so the ATO would say that the self-managed super fund trustee is likely consented for that distribution to remain unpaid. Because if it was a third party trust, you would say, hey guys, where's my money? Normally a trust distribution is paid within, say, 30 days. If the reason for the delay is the fact that there's not enough cash sitting inside the unit trust, then again, it might indicate some sort of financial accommodation. So in either case, we expect the ATO would consider that to be the SMSF lending the monies back to the unit trust. Now, that's going to cause us a problem because those sorts of trusts are not permitted to borrow. We'll taint the trust, which means that the self-managed super funds, units in that unit trust, will be caught as an in-house asset. And unless we've got a very, very large superannuation fund or a very small investment in this trust, we're likely to go over the 5% limit. So what could we have done instead? Reinvest the distribution. These trusts are exempt from the in-house asset rules if we follow all of the requirements, which means that we were perfectly entitled to reinvest the distribution into further units. That would not have caused an in-house asset problem, and we could proceed further and not having tainted the trust. So just making sure that in those sorts of situations that you are timely documentation around that reinvestment. If instead it's a pre-99 unit trust, then we potentially get a slightly different problem, because the example we had recently was a trust, a pre-99 trust. Again, 21-22 distribution hasn't been paid, and we asked the reason for that, and it was because they did some renovations inside the unit trust. Property was vacant, so did some renos, now doesn't have the cash to make the distribution through to the unit trust. Now, if it remains unpaid, just like the Reg 1322C, it's going to be an in-house asset. It's going to be considered to be a loan. So what are my options here? Well, I could reinvest it, but that will be an in-house asset because new units and pre-99 unit trusts aren't exempt, so it doesn't solve my problem really. I could perhaps introduce a new unit holder, but that potentially could have CGT stamp duty implications. Unit trust could borrow, so long as I do that on commercial terms, probably needs to be interest only, but it's only a short-term solution because eventually I'm going to need to be able to pay back that borrowing and still cash flow my distributions. So it'll be a short-term option if, for example, the property was renovated because perhaps we're about to put it on the market and we're going to get some cash in because we're going to sell the asset, for example. We can't do that. We're going to end up with some in-house asset issues. So just in summary, making sure that our related party leases, we get the appropriate rent and expenditure coming across. If the lease is going to expire shortly, making sure we're renewing that so that we've got a legally enforceable lease arrangement in place at all times. If we're lending monies to other entities, making sure that we're getting the appropriate interest and capital repayments coming in before the 30th of June. If the super fund happens to have borrowed under an LRBA with a related party, making sure all those safe harbour terms are satisfied. And then, as I said, with our related unit trust, making sure that we're either cash flowing the distribution or reinvesting it in a timely manner. And on that note, I'm going to hand over to Kevin.
Thanks, Lyn. I'm going to share my screen. And start my slide. Okay. Good afternoon. Good morning, everyone. I'm going to cover some of the tips and tricks around the end of financial year for FY23 and what you need to do to prepare for the new financial year, 2024. So I prepared 2 checklists for you. Now, the first one, Lyn already covered. Make sure you draw down your pension minimum before the year end, and this including your transition to retirement income streams. Take advantage of your catch-up concessional contribution. So strictly speaking, 23-24 will be the 5th year you carry forward any unutilized concessional contribution cap. And if you're not fully utilized an amount that carry forward from FY 2018-19 financial year, you will be lost, but you still have a bit of time up your sleeve. Review your non-concessional contribution and downsizing contribution. Obviously, given changing legislation from 1st January 2023, where they lowered age eligibility from 60 to 55 for downsizing contributions. So Class already, we had to update the system in March release because we have a few clients already are taking advantage of this, the new opportunity to do downsizing contributions. Maximize balance equalization opportunities. This including strategies like spouse contributions, contribution split, recontribution strategies. And this is mainly targeted for what I call lopsided super funds, where one member has much bigger balance than the other member. And the idea is simply for both members to enter into retirement phase, and they can fully take advantage of the transfer balance cap and earning tax-free incomes to support pension liabilities. The 5th one, regular review superstring rollover and release authority consoles in Class. And effectively, this will be used to manage your release authority obligations. Strictly speaking, this is not end of financial year, but it's kind of related to the last point because ATO is actually taking away the concessions for some self-managed super funds that do not use electronic service address that is superstring rollover compliant. There are only 5 commercial solutions in the market and 3 related to software providers. Class is one of them. And the other one is a paid solution through Australian Super and and worker, which is provided by ClickSuper. There are a few popular ones, including Macquarie Bank, which is ESA that only supports for contributions. So if you have some advisors or clients using that, but you're expecting they are getting release authorities or they want to roll over, you have to switch to one that support both contributions and release authorities. Now, for next financial year, obviously, Lyn already touched base about the reporting framework for TBAR is effectively moving to a quarterly basis from 1st July 2023. So we are truly moving into an event-based reporting framework on a quarterly basis. Always review funds with total super balance between $1.68 million and 1.9 as of 30 June 2023. For any non-concessional contribution opportunities, and this is because due to indexation of transfer balance cap, your total super balance is also indexed. That means some of the members previously not eligible to make that contribution, now they can. SG rate will likely to be increased from 10.5% to 11%. So do review your super stream contribution amount, and any salary sacrifice arrangement for particularly high income earners, potentially extra 0.5% may cause them to be over the concessional cap of 27,500. On 1st July 2023, one of the most important things is review members' personal transfer balance cap, their highest transfer balance cap, and the date they actually hit that, the earliest date they hit that highest transfer balance cap, and the available cap space, and compare that in class records with ATO's records and make adjustment as necessary. So I will do a quick demo of this later on. Prepare the final rollover for one-up funds on 30 June 2023. We know a lot of clients are winding up funds. Now, ATO has recently released a bulletin message to the SMS associations. Basically, they have extended the previously 14 days to 28 days post lodgement of a final return before they cancel your ABM. This should give you a reasonable amount of time frame for you to get the tax refunds and do the final rollover to another APRA funds or another self-managed super funds. Finally, educate your trustees and members not to pay excess concessional contribution, excess non-concessional, Div 293 tax assessment using self-managed super fund money until you receive the valid election to release the money from the self-managed super fund, the release authority has been issued by the ATO and received by the fund. We appreciate that there are a lot of trustees members are eagerly to pay their tax once they receive the ATO assessment, but they tend to use self-managed super funds money to pay those tax. Those tax are individual tax. They have to follow the process. Otherwise, this will be treated as an early release. It will be definitely reported as a contravention, and you need to do a voluntary disclosure to the ATO. Now I'm going to switch to class application, and we'll go through some of the screens in class. Okay, now this is the article they're talking about removing of that temporary relief for the electronic service address, and basically by 30 June 2023, those ones still doing paper superstream release authorities are no longer supported. Now, this is the register of all the supported self-managed super fund electronic service address, and as you can see, there are effectively, they have 6, but ClickSuper and the bottom one worker are effectively the same company. So there are 5 commercial solutions in the market. Now, I haven't found an article specifically about the extension of 14 days to 28 days. This is a blog article written by Smart SMSF, and they clearly mentioned that. So we are hoping ATO to update their guidelines on rollover instructions to clearly indicate the 28 days has been provided as grace period for people for them cancel the ABM before after lodgement of the tax returns. So I'm quickly going to show in class. Before I do that, so this is I've shown it a number of times with in my webinars. So this is the online service simulator from ATO. As you appreciate, a lot of people cannot necessarily find out the information about members' transfer balance cap. So once you log into your MyGov, this is where you access your super information and you click your transfer balance cap. So in this example, this member has previously established a full account-based pension, and this is her balance, and you can view the transactions, and it's actually hit on her account on 30 June 2021 of 864,000. That means she's got a proportional indexation, and her transfer balance cap space is effectively the difference between the indexed amount and which is 782. So I create this member on class. So unfortunately, when they initially did the this was loaded as 30 June 2021. When they initially entered the transfer balance cap information, they got the wrong date. On the ATO records, it's supposed to be 30 June 2021, but they incorrectly entered as 1st July 2021, which makes a difference of $54,000. So we need to correct that on class so that it will pick up the correct information, same as ATO. So to do that, I'm quickly going to show you, click Browse Events. So this is the event I did it. And all I need to do is edit this event and change the date. Then resubmit it. So in a new menu T-bar events, you can tick the box. And the difference is if you tick a box as adjustment, then it will not create T-bar events to be eligible with the ATO. It will just adjust the balance to reflect in the T-bar console. Okay, once you process this correctly, and we go to the members transfer balance cap information. So this is go through pre-order processing, T-bar console. And so you can go to transfer balance account, and that number should agree with the information from the ATO, which is 782,000, which is your cap space. Now, very important, what we don't know exactly what ATO's layout going to be for the indexation of 1st July 2023 indexation. We'll think it will be very similar to this, but you have your FY21 indexation and FY23 indexation. And it's important that you find out information, make an adjustment accordingly in class, so that you will have the right information for your clients and advisors to provide how much retirement-phase income stream your members can entitle to start with. So now I'm going to hand over to Dino to facilitate any Q&A.
All right, everyone. Thank you very much for that, Kevin. That was great. And Lynn, your one was fantastic as well.
Thank you.
Now, any questions that we can help with?
So Annie, is there any questions that you want to raise from your side of things?
I think I have answered most of them directly. Probably a question to expand on the 29170 notices, because Carolyn asked a good one about, do I really have to give the notice before a withdrawal comes out if my accumulation account is still big enough to include the contributed amount, and also if you want to expand on that a little bit more, Lynn, I think the next question we often get after that is what happens later on when I find out I don't have enough income for the member to use up the deduction. And if I need to vary my notice down, how do I do that?
Cool, thank you, Annie. Yeah, so it's a good question. The person who asked the question about, well, do I really have to give my notice before I take my lump sum out if I've got to have more than enough balance inside that account after the lump sum and after I've paid my 15% contributions tax to cover it? And unfortunately, the rules provide for a partial deduction. So if you've taken any lump sum from that particular account, unless it's a lump sum under a release authority, then I get a scale back of my deduction. I would need to have a very, very large accumulation account and a very small tax deduction for it not to make some bit of difference, because essentially even a partial withdrawal has a scale back of my tax deduction. So it's usually just making sure that you get your notice in before the lump sum is taken so that you don't have that risk of a partial scale back. Variations is a good question. So essentially all those rules that I had up on those slides before about when I have to give my notices, same applies to a variation. So if for some reason I had given a notice to the fund saying I've put in 27.5 and I'm going to claim a tax deduction for 27.5, I can vary that notice downwards, but the same timeframes apply. So if, for example, I've already gone to pension phase, taken a lump sum withdrawal, any of those sorts of bits and pieces, then I won't be able to make a variation because that variation will be invalid. So really, really important that either I don't have those events. So perhaps if I've got lump sums coming out, do I want to take those as partial commutations from my pension instead of lump sums from my accumulation account? Because if a contribution goes into the accumulation, lump sums comes out of pension, it's not a lump sum from the same contribution, same account the contribution went into. So I don't have to worry about those timing rules. That would give me some extra leeway to hold off in knowing exactly what level of tax deduction I needed before giving my notice, those sorts of things. But yes, it can be stuck with the situation where you have to give the notice because the event has happened and then circumstances change and you're then not entitled to that level of deduction. And unfortunately, you just can't vary the notice downwards. You won't get the tax deduction, but you can't vary the notice downwards. So it's still going to count towards your concessional contribution cap, still going to pay 15% tax in the fund, and unfortunately also count towards your non-concessional cap because you didn't actually get a tax deduction for it.
I've got a question in relation to class. So relation to T-bar manual adjustment, what if the client has a pension account outside of the self-managed super fund as well, and the pension account within self-managed super fund? Do you need to reconcile class to ATO T-bar value? The answer to that question is it's recommended. Obviously, there are some clients, administrators, they provide that information, share that information through ClientView and Investor app with the trustees, members, and advisors directly. So in order to provide accurate information and source of truth to them, it's best that you check with ATO records and update that in class as well, so that it will be consistent and before they can actually provide clients an advice on how much they can start another retirement-based income stream.
Anything else there, Annie?
There was a question for me about sharing the links on the articles, and we will do that in the Q&A sheet. So the notification from ATO about extending the grace period from 14 days to 28 days before they cancel the ABN, it was a bulletin message from the association, but I'm waiting for ATO to update the instruction guide as well.
Yeah.
Do we have time for one more quick question?
You go for it, Annie.
All right, it's a good one from Andrew. It's about your non-concessional contribution cap. And his question is, can a member contribute extra non-concessional contributions from 1 July 23 if their total super balance is at 1.68 million, even if their personal transfer balance cap is 1.6 million. So Andrew, it sounds like that someone go to pension already against their 1.6 million transfer balance cap, and their total super balance is under 1.7 million 30 June this year. So what can he do come 1 July?
Yeah. So yeah, great question, Andrew. So the changes to the non-concessional contribution thresholds, because the general transfer balance cap was indexed, and the fact that so long as my total superannuation balance is less than 1.68 at 30 June 2023, I've got a 330 non-concessional contribution cap. That is available to anyone who's eligible to make superannuation contributions. So long as I'm under 75, for example. The fact that your client's personal transfer balance cap might be locked in at 1.6 because they've already fully utilised it all, and they can't actually transfer any further money to pension phase is irrelevant. Your client is still eligible to put the superannuation contribution in because the general transfer balance cap changed, and that applies to everyone. So if she was then able to put a contribution in, it'd stay in accumulation phase because not able to transfer any further money to retirement phase because they've already fully utilised their cap. But certainly the contribution could go in.
Excellent, thanks very much. And we've run out of time just now, so I think we'll sort of say our goodbyes and thank everyone. So Lynn and Kevin, your information was fantastic. Your presentations were great. Having your brains on a page and seeing that information there was very excellent. Thank you so much for that. Annie, Chris and Calvin, behind the scenes, typing away for the questions. Thank you very much for your support. And to all the people who joined us today, thank you so much for joining us, and we hope to see you again soon.
Thanks, guys.
Thanks, everyone.
Thank you,
Bye.
everyone. Goodbye.